Hi guys, welcome back to my channel. So today I'm going to read an article entitled 4 Best Alternative to do Long-Term Care Insurance. These options may be a better fit to pay for long-term care. Long-term care insurance is a specific type of health insurance that helps people pay for long-term care. It covers the types of care not included in traditional medical plans, Medicare, and for people not eligible for Medicaid. Even though a long-term care insurance covers people with a variety of issues from different age groups, it may not be the best option for some. Long-term care insurance is expensive and not everyone is eligible, but these 4 alternatives can provide good coverage for those in need of long-term care. Key takeaways: to avoid being rejected for long-term care insurance or paying higher premiums, individuals can look to alternatives. Short-term care insurance is one option, which is essentially long-term care insurance offered for up to a year. Critical care or critical illness insurance offers coverage for those who are diagnosed by serious illnesses such as cancer. Annuities with long-term care riders of deferred annuities can be an alternative to long-term care insurance, potentially providing tax-free money when used for long-term care. Long-term care insurance affordability first and eligibility. Long-term care insurance can be expensive. It's also generally most cost-effective when purchased before people turn 60. In 2020, the average annual premium for a healthy couple both 55 years old is $3,750, according to the American Association for Long-Term Care Insurance. Even at this high premium, insurance companies that offer this type of insurance can reject applicants after probing more deeply into their health histories. Due to these factors, people may need other options for long-term care coverage. Short-term care insurance. Short-term care insurance, also known as cost-valence insurance, is a policy that typically offers between $100 to $200 per day of healthcare coverage for 1 year or less. Since there is no long-term commitment for the insurance companies, the premiums are normally less than traditional long-term care coverage options. The average short-term care premium for a 65 years old, for example, is $105 a month. With short-term care insurance, benefits normally reset. This means if someone files a claim but then recovers prior to receiving the full benefit, it is possible to file another claim in the future and receive coverage. Depending on the policy, only people under the age range of 85 to 89 are typically eligible for short-term. Second is critical care or critical illness insurance. Critical care and critical illness insurance are two types of coverage that offer lump sum cash payment to people who are diagnosed with cancer, stroke, heart attack, and other serious illness. Additionally, a flat and guaranteed trust life insurance. Two major carriers offer critical care and critical illness insurance with daily or monthly benefit for inpatient rehab and continuing care. Third is annuities with long-term care riders. For people who are rejected by traditional long-term care insurance providers, it is possible to take out an annuity with a long-term care rider. Money invested in an annuity with a long-term care rider can be used tax-free to pay for long-term care as defined under the contract. This gives a person a stream of monthly payment they can use specifically to pay for the care need. The fourth is deferred annuities. Long-term care can be replenished through the use of a deferred fixed annuity. If people take into account that they have 70% chance of needing long-term care after age 65, it is smart to hedge against future costs by putting money down prior to retirement in return of promise. Uninsurers will pay monthly sums beginning when a specific age reach. So this is all the article. Bye bye and see you on my next video. Hi guys, welcome back. So today I'm going to read an article entitled Group Term Life Insurance. So what is group term life insurance? Group term life insurance is a type of term insurance in which one contract is issued to cover multiple people. The most common group is a company where the contract is issued to the employer, who then offers coverage as a benefit to employees. Many employers provide at no cost a base amount of group coverage as well as the ability to purchase supplemental coverage and coverage for employees, spouses, and children. Group term life insurance is relatively inexpensive compared to individual life insurance. As a result, participation is high. Key takeaways: many employers offer basic group term life insurance at no cost to employers as part of a benefits package. It is possible and it may be prudent to have group term life insurance and an individual life insurance policy at the same time. When you leave a job, you may be able to convert a group term life insurance policy to an individual life insurance policy. However, for many, this option is cost prohibitive. And then how group term life insurance works. About 80% of companies offer company-paid group life insurance as a benefit, report the Society for Human Resource Management. Group life insurance policies are generally written as term insurance and offered to employees who meet eligibility requirements, such as being a permanent employee or 30 days after hire. Group term life insurance coverage can be adjusted from a qualifying life event during an open enrollment period. The standard amount of coverage is usually equivalent to the covered employee's annual salary. Employers typically pay most or all of the premiums for basic coverage. Additional employees' annual salary are usually offered for an extra premium paid by the employee. Insured members receive certificates of insurance as proof of coverage. As with individual life insurance, insured parties choose their beneficiaries. If your company offers group term life insurance, you may not be able to take it with you if or when you change job. Typically, employer-provided group term life insurance is not a portable benefit. Sorry. Advantage and disadvantage of group term life insurance. Group term coverage is generally inexpensive, especially for young people, and participants may not be required to go through underwriting as all eligible employees are automatically covered. However, unlike individual term insurance plans, which typically lock in a rate for 20 to 30 years, most group plans have rate bands in which the cost of insurance automatically goes up in increments, for example, at ages 30, 35, 40, and etc. The premium for each rate band are outlined in the plan document. While inexpensive in many cases, the amount coverage offered by group life insurance may not be enough and should be combined with an individual plan. Employers or associations group offering the insurance often limit the total coverage available to employees or members based on things like tenure, base salary, number of dependents, and employment status, such as a full-time, associate, or executive, with the amount of available coverage varying by the group. Another reason group insurance should be considered supplemental is that it's contingent upon employment. Coverage automatically ends when an individual employment terminates, and at the point, it may be harder. Some group life insurance plans may only cover accidental death and dismemberment. This AD&D policy primarily cover deaths of or severe injuries resulting from an accident. So that's all the article. Thank you for your nice attention. See you on my next video, and bye bye.